Yo, what's up, everybody? It is Monday, December 12th. Yeah, hope you had a nice weekend. Big day, big day up in the market today. Folks, I wasn't expecting to see a big day up like this because we're heading into that quarterly corporate tax drain that's going to happen on the 15th. When is that? Thursday? And we have the Fed meeting on Wednesday. They're going to raise 50 basis points, but that's pretty much all priced in. But anyway, yeah, today was a big rise. Now, what I'm seeing out there, it's kind of funny, actually. It's just like, I love looking at this stuff, and it's very comical, and it's very humorous to me, but it looks like the big guessing game now amongst the monetarists, because they were tweeting this all afternoon, was, is tomorrow's CPI going to be below 7%, year over year, or is it going to be above 7.5%? What's the over under? Are you betting on the 7.5%? Are you going to bet on the under 7%? JP Morgan said if it comes in under 6.9%, that the S&P is going to be up 10%. I just get a kick out of this stuff, folks. It goes back to what I said in a previous video, that you literally have trillions of dollars on Wall Street being managed by people who are playing this game. Is it going to be 7.5%? Then we'll do one thing. Is it going to be 7%? Then we'll do another thing. It's totally ridiculous. It is totally and completely ridiculous. Just think about it. This is manic. This is just up, down, up, down. These people have... Here's the other thing that is very, I think, obvious when you see this kind of rationalization of what they're doing. They have to constantly, reframe the narrative in order to be, true to their monetarist view. Okay? So think about it, because when inflation was going up, right? And it was all transitory. We see that now. When inflation was going up, that number 7% on the upside when we were going up, they were freaking out about that. They were freaking out about 7%, remember? And now it's like 7%. Yeah, the market's going to go up 10%. It was what's the difference between the 7% now and the 7%? I get it. Now we're coming down a little bit, but it's still high. The Fed is still, they got to constantly reframe their narrative in order to stay true to that monetarist bullshit. And that's what it is. It's just total bullshit. It's just, I've used the term, and I use the term often, zombies, and it's really like zombies. They're like, we'll go this way. No, the number's this. We'll go this way. Can you imagine, if you're out on the open ocean trying to navigate like that? You're trying to get someplace, right? And then you see a squall over here. And so you move in the other direction. You turn around. Then there's a squall in that direction. Then you turn around again. Then there's something over there. There's good weather over there, so you head that way. And then that good weather turns into bad weather, so then you head over in that. You're never going to get to where you're going. You're gonna either run out of fuel, or if you're sailing, you're going to starve to death because you're eventually going to run out of provisions, and you're never going to get to where you're going. It's the same thing, folks. It's the same thing. This is why, I've been telling you guys, the first derivative is the fiscal flows. That, and I've tried to dumb this down. Not that you guys are dumb, you're not, but I tried to put it in the simplest metaphorical terms. The swimming pool. Everyone could grasp that. I know everyone could. Is it filling up, or is it getting drained? And if it's filling up, at what rate is it filling up? In general, the rate at which it fills up is pretty steady. Okay, the thing is, we went through 2 years with the pandemic stimulus where it was coming out like a gusher. Okay, and that was unprecedented what we saw there. I mean, it was coming out. The water was being pumped into that pool like a super pumper. You ever see those fire engines that are super pumpers? I don't know how many gallons per second, but like they can literally knock down, the water coming out of those hoses can knock down solid brick walls. So yeah, we got a little jaded from that because that was a period that was unprecedented, and we didn't have any dips. So everything was straight up because that pool was not only just filling up, it was overflowing into everybody's, the balances, the financial balances of the non-government, of the economy, just became flush with deposits. But in general, the rate of flow is pretty steady. We're back to around leading flows now, monthly leading flows around 500 billion. Actually, it's been picking up. Now we're kind of like around 550 billion. Last year, earlier this year, it was averaging under 500 billion, like maybe 480 billion. So we have picked up. And that's good. So, and the fact that the government runs deficits, that means it's always adding to the swimming pool. So our job is really just to kind of figure out the rate. I mean, if you want to, you don't even have to really do that, because as long as it's filling up the swimming pool, then over time, that lifts everything up. That just adds more to the financial balances of the economy. And that's a bullish thing, okay? Because that means income, that means savings, that means more investment, and that's all positive stuff. And we would have to worry if the government starts to drain on a regular basis. In other words, like, let's run surpluses constantly. But they can't do that. And the reason they can't do that, I told you, it's really political, because, three of the biggest things are just automatic appropriations. That's Social Security, Medicare, Medicaid. All right? Those things combined are over, that's like well over 2 trillion. And then we have defense, which, even though it's discretionary, it's treated like an automatic appropriation. I mean, we just saw last week, they just passed another increase in the defense budget. The only thing I would say we have to worry about short term is the debt ceiling. They haven't raised the debt ceiling, which, of course, the debt ceiling is a ridiculous, anachronistic, self-imposed constraint. It shouldn't be there. They should get rid of it, but they're never going to get rid of it, because both sides, when they can, they will use it as political leverage. And, it's not only about that. I have to say that I would say a vast majority of people in Congress really believe that, we ran out of money and we're broke and we borrow too much. Okay, that is a belief, because sadly, they see the government's finances as the same as a household, but it's different, because us as households, as individuals, we're not currency issuers. We're currency users. But all of you, I'm sure, are aware of the distinction. You've all been following me or other MMT people for a long time, so So that's basic MMT understanding. The government can't run out of money, and the debt ceiling is a self-imposed constraint. And the United States is one of the few countries in the world that imposes that debt ceiling on itself. As far as I've been able to determine from looking at other countries, I think Australia has a debt ceiling too, but they basically just ignore it, or they put it at a level that it's not an impediment. But so if we hit the debt ceiling, and we're very close right now, Treasury can operate for a period of time under what's called extraordinary measures. And that's, I suspect, what Janet Yellen would do, so that would continue to make payments, so that's not a problem. But if it got to the point where they can't make payments, then we got a problem in the fiscal flows. But I don't really see that happening, for the simple reason that, if they can't make payments, then guess what? they can't send another 10, 20 billion to Ukraine, and they're dying to do that, or they can't fund the military. And that, that's way more important. And we know this, that in this country, in the United States, nothing is more important than giving the military money. And so they're going to have to come up with something, because they just passed this big increase in the defense budget, and they're going to need to raise the debt ceiling in order to give all that money to defense contractors and everything else. So I wouldn't worry about it too much. But let me get back to the initial thing that I was talking about last week and even the week before, and even now, I said it now on Thursday, we have that quarterly tax drain. So even though today we had a big up day, and even though they're talking about, tomorrow could be a 10% increase in the S&P, which would be, that'd be some fireworks, let me tell you. I still think that tax drain is going to create a little turbulence for the rest of this month. Could be wrong, but in general, these tax drains have, had impact, certainly this year, for sure. I mean, last year it was less impactful because, again, it was being offset largely by lots of stimulus, and also in 2020 when we had massive stimulus too, we really didn't feel anything from any of these tax drains. But this year, we're back down at what I call more or less normal flow, normal fiscal flow. Although normal now is still, way more than what the normal was pre-pandemic. Like pre-pandemic, during the Trump period, pre-pandemic, government was doing about $425 billion a month of net leading spending flow. Now we're doing about 550 billion, and I'm calling this the new normal. So it's, what's that like? It's like 30% up from the previous normal. So it's very, very good. It's very, very good. And so, then, tomorrow's going to be interesting with that CPI number. But again, I just got to come back to this, because to me, it's just, I look at it as an outsider. I don't play this game. I don't jump around headline trading. Getting back to my analogy of, being out there on the open ocean and navigating, I have my compass, I have my GPS, I have my charts. I know where I'm going. A squall, good weather, bad weather is not going to deter me. I know where I'm going. I'm not like jumping from here to there. The things I look at, the first derivative of everything, tells me where, I'm headed. And that's what I'm trying to impart to you guys. It's not that hard to have the macro picture. And the macro picture is really the thing that you need, because from the macro picture, you could drill down to, even any kind of bottom-up analysis. If you're looking at numbers, I've had this argument with analysts, with stock analysts before. They're like, oh no, we don't really pay attention to the macro because we're bottom-up guys. And I'm like, even in a bottom-up, what is bottom-up? They're crunching numbers. They look at balance sheets. They look at income, they're looking at cash flow, they're looking at debt levels, all that kind of stuff in individual stocks, individual companies, which is great. I mean, that's a real skill, and that's very, very valuable. But if basic economic conditions are not conducive to, kind of a growth environment, then all that number crunching, it's great and it's nice to have, but it's not going to be that helpful, maybe over time, but it's not going to be that helpful. I mean, what you want to ascertain is, what do basic economic conditions look like? And again, I gave you guys like a metaphorical way to think of it, the swimming pool. Nobody's ever, kind of put it in that way, but I think that's a very easy way to understand it, and it should be of a lot of help. So we'll see what happens tomorrow, folks. They're going to be jumping all around. I would not be surprised even if we got a big rally tomorrow, by the time Thursday and then next week rolls around, when that drain hits, when that corporate tax drain hits, we could see the market give some of it back. But that doesn't make me bearish. As I said in the last video, these things now on a quarterly basis and the April 15th tax drain, it's just something you got to know. Again, using the navigation, these are little squalls and storms out there that we're going to run into occasionally, and you just have to navigate through them. But the good news is they provide really good buying opportunities. So if you have some cash on the side when we go through these things, you're going to be way ahead of the game. Way ahead of the game. Anyway, that's it for today, folks. See you tomorrow. Bye.